distinguished guests and friends from the press. First, thank you very much for inviting me to give this talk on this very auspicious day for Assocham, Karnataka. Now, ordinarily in a city like Bengaluru, we talk about startups. But what I want to talk about today is really the resolution of financial distress. And, to some extent, I'm talking about obituaries rather than birth announcements. And I feel like in the last few days I've read a lot of my obituaries. And, I'm still here. I'm still here for 2.5 months in this job. And after that, I will still be around somewhere in the world, probably a lot in India, so don't write me off. In the spirit of removing darkness, which was alluded to earlier, lighting the lamp in praise of Saraswati, in praise of the illumination that she brings, and removing darkness, I want to talk a little bit about what ails India today. Why is it that many of you small business, medium-sized businesses, as well as some large businesses, find difficulty? And what is the solution to all this difficulty? And to preview, I'm going to argue that the slowdown in credit growth, as well as the tightness that many industrial firms are facing, is largely because of stress in the public sector banking system. And what is required to restart it is a cleanup of the balance sheets of the public sector banks. And this process is underway. The public sector banks have risen to the occasion and have done more than what was expected of them. And my belief is when this process is taken to its logical conclusion, they will have sustainable balance sheets to support the growth that this country very much needs, the extra growth that it needs. Now, what this cleanup process has also entailed is really a change in the culture surrounding the loan contract in India. And I want to talk a little bit about that because some of the structures that we in the Reserve Bank have brought in have also been to change this culture associated with credit. I will also in the process address the issues about declaration of NPAs and so on, especially vis-a-vis small and medium sector. So to start with, let me go to evidence. My friend Surjit Bhalla in Delhi has a column which is entitled No Proof Required. And I think it's a tongue-in-cheek statement about the fact that so much of debate in India takes place without any evidence. And as a result, anybody can say anything and get away with it. So what I want to do is show you some slides, and I want you to conclude from this. This is not regressions, this is not complicated economics, this is just some slides. And I want you to take away what the logical conclusion from all this is. Okay, so let's start. Slide 1 is non-food credit growth. Okay, this is credit growth, but it's broken up into two groups. One is the private sector banks, the new private sector banks, the biggest Axis, HDFC, ICICI and IndusInd. We've left out Kotak because it did a merger during this period. So that's the light yellow line. And what we've plotted here is credit growth. So what you can see is non-food credit growth is hitting 25% a year for the private sector banks. That's fantastic. That's about as strong as it ever gets. Look at what's happening to the public sector banks. It's shrinking, it's below 10%. Okay? And that's something to worry about because the public sector banks are the biggest banks in our economy, accounting for about 70% of the assets of the banking system. Now, you may argue this is because the sectors the public sector banks in. Well, let's look at the sectors. If you look at credit to industry, industry is suffering. People say there's no credit demand in industry. Look at what's happening to the private sector banks. Once again, credit that they're giving is north of 20%. Credit growth is hitting 20% per year by the private sector banks. What's happening to the public sector banks is going negative. Now that's an aberration because Uday bonds have been taken out of the credit column for them and put in the investment column. But nevertheless, credit growth was falling. The rate of credit growth was falling and was below 10%, below 5% for them to industry. So industry is not getting credit, not from everybody, but from the public sector banks. Look at agriculture. Private sector banks and public sector banks were going neck to neck in early 2014. By the way, all these numbers start in early 2014, April 2014, and go on to the current period, okay? So let's go back to agriculture. And what you see in agriculture is they start about the same in April 2014, and again they diverge. Private sector banks are lending more credit, have more credit growth to agriculture than public sector banks. In a period of drought, when you think the public sector banks would be going out and lending, the private sector banks are lending at a faster pace. Now, there may be different bases. Private sector banks may start out with a smaller fraction of lending to agriculture. That's not necessarily borne out by this graph, but nevertheless, this is an issue of interest. You mentioned small and medium enterprises. Public sector bank growth to small and medium enterprise, 0. That credit growth to small and medium enterprise from public sector banks is 0. Private sector banks, again, north of 25%. Okay? And again, this starts not now, but from 2014. Steady decline from early 2014. Okay? Personal loans, here the picture is different. Public sector bank credit growth to personal loans is picking up over this period. These are loans to individuals, retail loans, and so on, and reaching closer to where the private banks were. Private banks were always strong in personal lending. Public sector banks are getting closer. And housing loans, there's no difference now. Public sector banks are growing their housing loan portfolio at the same pace as the private sector banks. Okay, so what is the point of all these charts? I think the point is to take away what the implications are. First, it's not that the entire banking system has stopped lending. Now, if the entire banking system stopped lending, you could either say that it's because low demand, and you could blame things like monetary policy. Interest rates are too high, nobody's borrowing, there's no investment, no credit growth. This is because of the RBI, set interest rates too high. But if the private sector banks are lending, typically private sector banks charge somewhat higher interest rates than public sector banks. Private sector banks are lending and there's strong demand for their lending, so much that their growth is 20-25% in each of the areas. That says it's not monetary policy. How can the private sector banks be lending so strongly to the small and medium enterprises while the public sector banks are not lending? Now you may say it's something to do with the public sector banks. Maybe they don't have enough capital. But then why are they increasing their lending to retail loans and housing loans? I think the conclusion you have to come to from looking at this evidence is that the real problem is they have a lot of exposure to distressed sectors in the economy, and they are trying to reduce the exposure, clean up the exposure, especially to things like infrastructure, to steel and so on. And private sector banks in the meantime are much healthier, have lower exposure, and are able to increase their exposure sometimes in those very sectors. So the answer to how we move ahead has to be that we have to increase the pace of cleanup. Now, one of the things you could argue is that it's the cleanup itself which is the problem. The cleanup, the asset quality review, is forcing the public sector banks to shrink lending. But if you look at the chart, well, take a look at this chart, for example. The slowdown in public sector bank lending has been steady right from April 2014. The RBI stopped forbearance in April 2015, and the asset quality review started in end 2015. Unless the public sector banks had perfect foresight and could see the future, it's hard to argue that was responsible for the slowdown in lending. So once again, the conclusion is that a growing distressed portfolio in certain sectors made the public sector banks either more risk averse or less willing to take additional exposures in those sectors because it's such a big part of the banking system. As a result, lending growth in those sectors fell considerably and stress in those sectors increased some more. Okay, so let me then move on from this to talk about what the sources of stress might be, and let me go back to the front. Let me go back to what the sources of stress might be and talk a little more about how we've been trying to help the banks deal with them. So there are two sources of a loan turning bad on a bank balance sheet. One is the fundamentals of the borrower are not good. The borrower cannot generate cash flows and as a result cannot pay. That's one source of stress. The second is the lender's ability to collect is weak. Even though the borrower generates the cash flow, the lender cannot persuade the borrower to pay. I think both factors are at work. The first factor, more significant, that fundamentals have deteriorated for the borrowers that are highly levered, but to some extent their willingness to pay has also been more limited. So let's first talk about why these loans were made and why the fundamentals turned adverse for them, why they could not pay. A number of these loans were made in 2007, 2008. Economic growth at that time was very strong, and people expected infinite possibilities. India was India shining plus plus, because we had 4 or 5 years after those initial years of growth, again of very, very strong growth, 9 to 10%. So at that time, deposit growth in the banking system, especially the public sector banks, was also very strong, 23, 24%. When you have strong money coming in and people with seemingly limitless prospects coming to your door and asking for loans, there is a very strong incentive to lend. And it was especially strong because the recent past had been, a lot of projects had been completed on time. Projects such as power plants, they'd been completed on time, within budget, and people who had made those plants wanted more. They wanted to invest more. They wanted to do more investments. It is at times like that that across the world banks make mistakes, because they extrapolate past growth and performance to the future, and so they're willing to accept higher leverage in projects and less promoter equity. Now at that time, the frenzy resembled the frenzy elsewhere. Banks were willing to sign up to lend based on project reports by the promoter's investment bank without doing their own due diligence. So they relied on other people's due diligence, especially people who may be working for the promoter himself. One promoter told me that he was pursued then by banks waving checkbooks, asking him to name the amount that he wanted. Please take money from me, because I've got plenty of it. I need to put it to work. This is an example of irrational exuberance, which is common across countries at such a phase in the cycle. You don't need to imagine there's something terribly wrong going on. I will talk about that in a while. There was some of it. But there was also a general optimism about the economy, and therefore a willingness to take risks. And of course, the problem with such kind of optimism is that the future doesn't turn out as you expected. The years of strong global growth before 2007 were followed by the global financial crisis and then a global slowdown, which extended even to India, showing how much more integrated we had become with the world during that period. So at that time, the strong demand projections for projects turned out to be unrealistic. The demand that the promoter expected didn't show up. The roads didn't produce as much vehicular traffic, for example, or the steel that was required was much lower than was anticipated. Also, at the same time, a variety of governance problems, coupled with the fear of investigations, slowed down bureaucratic decision-making in Delhi. And permissions for infrastructure projects became hard to get. So projects incurred tremendous cost overruns. And as these stalled projects saw their debt load increase, they became increasingly unable to service debt. So there are perfectly natural explanations for how the stress built up, but I'm not saying there was no malfeasance. Of course, we know that our country's investigative agencies are looking into some cases where undue influence was used in getting loans, or where actual fraud was committed by diverting funds out of a company either through over-invoicing imports sourced via a promoter-owned subsidiary abroad, so you pay too much for the imports and therefore you've essentially siphoned money out, or exporting to shell companies out abroad and then claiming they defaulted, therefore essentially siphoning out money again in a different way from your company. But I'm also saying that despite some instances of this kind of malfeasance, there were typically other factors than malfeasance also at play, and a number of genuine committed entrepreneurs, including many in small and medium enterprises, are in trouble because even though and despite banks having made reasonable business decisions when they were giving the loans. And the truth is that sensible lending, even sensible lending, the most sensible lending, will entail default. A banker who lends with the expectation of no default and with the intent of no default is probably being over-conservative and hurting the investment of the economy. But a sensible lending does mean the best upfront assessment that you can make of project prospects, and also after you make the loan, careful post-lending monitoring, including careful documentation and perfection of collateral, ensuring that the assets backing the promoter guarantee are registered and tracked, and tracking the project itself to see that it's on course, that the investment, the money that you're feeding into the project is actually invested properly in it. Unfortunately, too many projects were left weakly monitored, even as the costs increased. Now, some banks may have expected the lead bank in the consortium to exercise adequate due diligence, but this did not always happen. Moreover, as a project went into distress, private banks were somewhat more agile sometimes in securing their positions with additional collateral from the promoter, or getting repaid by the promoter, even while public sector banks were staying with their loans or even supporting the project with fresh loans. Promoters, often seeing the writing on the wall, stopped infusing equity and sometimes even stopped putting in effort, knowing that the project was unlikely to repay given the debt overhang. Now, we do have reasonable laws like SARFAESI which are intended to speed up the collection, especially of secured debt. But even the implementation of collection under these laws has been prolonged and costly, especially when banks face large, well-connected promoters. The government today is proposing reforms to the judicial process, including speeding up the functioning of debt recovery tribunals, which should make it easier for banks to collect. But those reforms are still before Parliament, and Parliament has to enact them hopefully soon. Now, knowing that banks would find it difficult to collect, some promoters encouraged them to double up by expanding the scale of the project, even though the initial scale itself was unable to service the debt. Of course, the unscrupulous amongst the promoters continue to divert money from the expanded lending, increasing the size of the problem that has eventually accumulated on bank balance sheets. Now, we must recognize that the inefficient loan recovery system gives promoters tremendous power over lenders, especially if lenders have large exposures to the promoter. Not only can they play off one lender against another by threatening to divert payments to the favored bank, they can also refuse to pay unless the lender brings in more money, especially if the lender fears the asset becoming a non-performing asset. Sometimes, knowing all these problems, the promoter can offer miserly one-time settlements, knowing that the system will ensure that the banks can collect, even on secured loans, only a small fraction. So knowing that you can, as a banker, can collect 10%, I will offer you 10%. and as a one-time settlement because I'm going to use the system to keep you from getting my assets. Effectively, in such a system, loans become implicit equity, with a tough promoter enjoying the upside in good times. He gets all the upside from his equity going up, and forcing banks to absorb the losses in bad times even while he holds on to his equity. So it's heads I win, tails the bank loses, right? It's not an equitable system. Now, in cleaning up the banks, we have tried to keep these inequities in mind and noted there are three broad principles the world over when you do bank cleanup. The first is that viability doesn't depend on the debt that is outstanding, but on the economic value the project can create. The debt is a claim on someone. The claim is an obligation to someone. But the true value of the assets depends on the viability, the economic viability of the project. Does it produce cash flows greater than the costs? If it does, the project is viable and can be kept alive. It may not be enough to service the debt. Okay? So in that case, the debt has to be realistic. The creditors have to be realistic and accept the fact that some of their debt can never get paid, but if they write down the debt, the lower value of the debt can in fact get serviced by the viable cash flows, right? Now, this is something that requires creditors to understand that bygones are bygones. They may have been exuberant when they lent to the project. The project may have taken on a lot of money and owe a lot, but what can be repaid may be a fraction. If the debt is not written down, the project will turn into an NPA, and the promoter, knowing that he can never repay the debt, may in fact lose interest and worse, start siphoning out assets from the company, knowing that it is no longer a viable asset. In that case, the assets depreciate rapidly because of unviable levels of debt. Second principle, that sometimes projects are stalled, but if they will be viable on completion, even if it requires additional investment, we should make that investment, because when we make that additional investment, the project will start paying. If you didn't make that investment, it would never pay. So the cardinal point to remember is stalled projects do not get better over time, they get worse. They deteriorate because the assets depreciate, they're kept in the open, the machinery gets rusted. You cannot leave a project stalled for a long time and expect that you will get value. Better to invest if in fact the investment is repaid by the viable cash flows that are generated, right? So the new loan, even in a project that is highly indebted but stalled, new loans may be useful, even if the old loans are NPAs, because it sets the project going and starts producing the cash flows. Okay, so sometimes it makes sense to lend into stalled projects with high debt levels, if the project is viable. But then there are a whole set of projects which are unviable, where there's no hope that the project will produce more cash flows than the costs. Okay? In that case, don't buy the promise of the promoter saying, just give me more money to double the size of the project and I'll pay you off. If the project was unviable at the current size, it probably is going to be unviable at double the size. Many of the economies of scale that are often proposed tend to be illusory. And therefore, when promoters who have overborrowed often propose an increase in scale so that the bank's new outstanding debt and new loans will all become serviceable, be very careful. It's a promise that has to be looked at very carefully, because an incompetent or unreliable promoter will remain so even when scale expands. So these are the three rules which I think one should keep in mind. Essentially, get the project back on track if the additional investment will repay, but if the project is not viable in the first place, doubling the size of the project typically doesn't make any sense. And let us not get into bigger and bigger holes, know when to shut down because it's unviable. Now, unfortunately, The incentives built into public sector banks have made it more difficult for executives to follow these principles. And I should add that this is not entirely only a problem in public sector banks. Sometimes it extends to private sector banks elsewhere and in India also. And the real problem is a short tenure of managers, which means they are unwilling to recognize losses immediately and shut down that project which is unviable, and more willing to postpone problems into the future for their successor to deal with. Such distorted incentives leads to overlending or to evergreening unviable projects. And in addition, the taint of an NPA immediately makes them reluctant to lend to a project, even if it's viable, for fear that the investigative agencies will not buy their rationale for why they lent. This absence of sound and well-documented loan evaluation and monitoring practices by these banks makes such an outcome, such an unpleasant investigation, more likely. So we can, in the public sector system, get too much lending to the bad projects that need to be shut down and too little lending to viable projects that need to be supported. The sense of discrimination can be distorted. Now, I've talked a little bit about what promoters think and may do. I've talked a little bit about what the incentives of the public sector banks are. Let me talk a little bit about the regulator and what the regulator wants to do and what the constraints are. The regulator wants the banking system to clean up so it can start lending again. Now, this creates a variety of objectives given our current system, some of which can be conflicting. For example, we want banks to recognize loan distress and disclose it, not paper over it by evergreening unviable projects with fresh additional loans, okay? So we don't want banks to lend to somebody to repay them when that project is unviable. The point about loan classification is it's merely good accounting. An NPA is not anything about who's to blame. A perfectly good entrepreneur with an excellent history and perfectly good intentions can go into an NPA because demand turned out to be less than he projected. That's bad luck. Luck can go anyway. And what the NPA label basically does is it's an accounting norm. It says thus and such loan is not paying. It says nothing about entrepreneur good, entrepreneur bad. That's why in front of the Supreme Court we've said we do not want to divulge the name of all defaulters because that has an implication or a connotation that this is a bad thing. And as I said earlier, if we have no defaults in the system, we are being overly conservative. So even good entrepreneurs can default. Let's keep that in mind. But in addition, when an asset is recognized as an NPA, banks also provide for it, recognizing there might be losses in that asset over time, and those losses will hit the bank's value. So provisioning sets aside a buffer to absorb the likely losses. If the losses don't materialize, and that is happening in the US today, banks can write back those provisions into profits. So they will become much more profitable in the future if they over-provisioned in the past. If the losses do materialize, the bank suddenly doesn't have to declare a huge loss which surprises all its investors. It can essentially write down the provisions, right? So essentially, loan classification and provisioning is good accounting practice, recognizing the fair value of assets and ensuring there are no surprises to investors. So what we want to do is help them achieve that loan classification. The second thing we want them to do is be realistic about the project's cash generating capacity and structure the lending and repayment to match that. We don't want them to have unrealistic estimates of what will happen because that will mean the loan will turn NPA down the line, if not today. Third, we want them to continue lending to viable projects that can give good employment to workers, that can support the country in its growth, even if these projects were restructured in the past and are NPAs. I want to keep emphasizing their bad projects are unviable projects. But if there is a good project which is viable, it doesn't matter that it was an NPA in the past. We should support it so that it can produce the cash flows that are needed in the country. Now the problem is all these things don't work together. Any forbearance in labeling a loan an NPA, we tell them don't worry about labeling the loan NPA, then bankers get more incentivized to avoid disclosure and to indulge in evergreening. On the other hand, if we emphasize a very strict disclosure and classification rule, that implies a cessation of lending even to viable projects. So the point is, there's no clean solution here given the incentives that are in the system and given that we don't have a clean operational bankruptcy code in India. Yes, one has been passed through Parliament, that's an enormously important development, but it will take some time for that to be operationalized, and in the meantime, we have to fix the problems in the banking system, given that credit is suffering today. So what we've done is adopted a pragmatic approach to the cleanup, creating a variety of enabling processes, all the while acutely aware that the incentives in the banking system sometimes don't imply that banks follow the spirit of the new structure, but sometimes tend to evade the spirit. And we've constantly tried to make changes so that they indeed respect the spirit of the structures that have been put up. So let me quickly walk through the structures. We started first by creating a large loan database in early 2014. Turned out that in the system, one bank that lent to borrower A did not know that another bank had lent to that borrower. So borrowers could first borrow from multiple borrowers without one knowing about the other. It was not supposed to be that way. He had to diverse to them, but he could get away doing that. And similarly, one lender did not know what the performance status of the other loan to that borrower was. It could be NPA in my account, but the other lender did not know that it was NPA in my account. So the first thing we did was collected all the loans that were made to borrowers, all large loans above 5 crores, created a database and shared it with all the banks. So every bank could see what every other bank was doing with respect to that borrower and know what the status of the loan was vis-a-vis that borrower. So if it was NPA on this bank's books, the other bank could see that it was NPA. This allowed us to identify early warning signals of distress. A loan that hadn't been paid for 30 days, a loan that hadn't been paid for 60 days. Way before the NPA, we could classify that it was getting stressed, and loans that were repeatedly paying on the 89th day, on the 88th day, we could see that the borrower was definitely in stress and playing off one bank versus the other. So the next step was to coordinate lenders, and we've done that through the Joint Lending Forum, which is supposed to be formed as soon as these early warning signals of distress are seen. And the Joint Lending Forum is much like a bankruptcy court. It is meant to get the lenders together, including NBFCs and insurance companies, and make quick decisions about the resolution of the assets, whether it should be, whether we need more lending, whether we need some other action, whether we need restructuring of loans and so on. Now, we wanted to stop restructuring of unviable projects by banks that wanted to avoid recognizing losses. So we ended the ability of banks to restructure projects without calling them NPA in April of 2015. However, we left a couple of loopholes. Projects that had a long duration and had cash flows way into the future, banks had structured them with overly short-term debt, which had to be repaid quickly. Recognizing there would be cash flows down the line, we allowed what was called the 525 scheme, which would allow payments to be extended much further if you had cash flows that were going to be generated over the long run. For example, a road project would last 30 years, would produce cash flows over 30 years, so we allowed the debt effectively to be structured as if the payment would happen over 30 years. Then, because promoters were often unable to bring in new funds, and because the judicial system often protects those with equity ownership, together with SEBI, we introduced what was called the Strategic Debt Restructuring Scheme so as to enable banks to displace weak promoters by converting debt into equity. Now, we didn't want banks to own this project indefinitely, so we indicated a timeline by which they had to find a new promoter. All these tools effectively created a resolution system which we did not have, which replicated an out-of-court bankruptcy. Okay, so this work was intended to give banks the power to resolve distress, and then, having given them these powers, having created these powers, we worked to push them to exercise these powers by forcing or I would say incentivizing recognition. This is what the Asset Quality Review started in and completed in 2015, completed in October 2015, and subsequently shared with banks. This is what it sought to accomplish. Banks since then have classified existing distressed loans appropriately, and since March 2016 are looking at their weak but not yet distressed portfolio for necessary actions. I have to say that we have seen a change in culture in the public sector banks vis-a-vis these loans. That a number of them have gone beyond what we have required, got into the spirit of the AQR, and gone significantly beyond in terms of identifying the weak assets on the balance sheets and classifying them. Of course, once the banks have properly classified a non-performing loan and provisioned against it, their incentive to evergreen or avoid writing down the debt to appropriate levels is diminished, and they can take a pragmatic and sensible view vis-a-vis the bad debt. And we're seeing some of this happen. We're seeing promoters brought to the table. We're seeing a number of promoters selling assets. So the cleanup is well underway, and everybody is coming into the act. However, there are still some issues. Most recently, we found that weak promoters could be dealt with by the SDR, which took the weak promoter out of the equation by taking up equity in the firm. But some promoters are still quite good, but unfortunately are distressed because, for a variety of reasons beyond their control, as was suggested earlier in the opening introduction. So the Scheme for Sustainable Structuring of Stressed Assets, we call it S4A, lots of acronyms here, but this is an attempt to get banks to work with competent promoters to give them a little bit of a lifeline by writing down portion of the debt, keeping only what is serviceable of the debt as outstanding, with the idea that over time, as the promoter recovers, he may buy back the remaining portion which has been converted into equity by the banks. Now let me emphasize, because this is early days, that S4A is not a free pass to habitual defaulters or those who can bring in cash or those who have reputations for milking their companies. We have asked the banks to be very careful. This is not a way for those promoters who are brought to the table to negotiate before to escape. And we will be watching the transactions that are done initially. This is not meant for the habitual offenders. Let them be warned. Most recently, the government is contemplating a fund to lend into distressed situations with significant participation by third parties so that loans can be made to viable projects. I told you, banks sometimes, once a project turns NPA, just get overly stressed and don't want to lend anymore. But those projects may be viable, may require funds, and the government is thinking of a new stressed asset fund to make this possible. So when we have so many schemes, people ask, why so many schemes? Why are you bringing one scheme after another? Well, the problem is that we have a variety of lending situations with a variety of incentives both for the banks as well as the promoter. Ideally, we would have an effective bankruptcy scheme, but we don't. So we've had to recreate a bankruptcy scheme with all the incentives taken care of through a variety of schemes. We've monitored these schemes, and wherever we found deficiencies, we've again adjusted. Our objective is not to be theoretical, but to be pragmatic and to make sure that these schemes help clean up. And the good news, as I said, is banks have gotten into the spirit of the cleanup and are pursuing promoters, reluctant promoters, while helping energetic and enthusiastic ones to rehabilitate projects. Now, to facilitate the sale of projects, we are shortly going to license a number of asset reconstruction companies to provide a deeper market for these stressed assets. We're also working on a framework to enhance the efficiency and transparency of price discovery in the sale of stressed assets by banks to ARCs. Now, after an initial negative reaction by the market to the asset quality review and the size of the provisions that banks were taking, the markets since then have become a little more understanding and have built up public sector bank shares. Now, those shares are still trading at a fraction of book value, which suggests that if the cleanup is properly done and credit growth starts getting restored in the public sector banks, there's still some value that can be created in those banks for investors. Now, in all this, I've not talked about fraud and willful default. Now, we are trying to make it easier for committed, good promoters to restructure when they experience bad luck or unforeseen problems. But at the same time, we should reduce the ability of the fraudster or the willful defaulter who can pay but simply is disinclined to pay to get away. And this is extremely important, and this is why we have coordinated with SEBI to enhance the punishments for willful defaulters if in fact they are labeled thus and such by the banks. For the fraudsters, we have emphasized the importance of first maintaining data on them, and second, coordinating the prosecution of these fraudsters. The Prime Minister's office has been keenly monitoring the prosecution of large frauds, and I'm hopeful that if a few of them are brought to justice, it will send a very strong message to people who are in many ways exploiting the industrialists in this room by raising their cost of finance, raising the premium they have to pay. You don't want a few bad eggs in the whole basket spoiling the credit environment for a lot of good, sensible entrepreneurs. Now, there are concerns that bankers have exhibited about the investigation of frauds. Sometimes vigilance authorities are accused of excessive zeal. Of course, the vigilance authorities respond that what we want to do when we come in is see that processes have been followed, that in fact a sensible decision has been taken by applying one's mind based on data that are available now. It's not that every time there's a default we come back and prosecute, but when there is sloppy work that has been done, we worry about it and we try and take the banker to task under those situations. Unfortunately, there are instances where bankers, as I argued earlier, have done relatively sloppy work in making loans, and as a result, it's hard to tell sloppiness from malfeasance and corruption. And that's the problem that investigative agencies face. Part of the solution has to be that going forward, bankers pull up their socks, that loans are made based on appropriate due diligence, not with excessive risk aversion, but by looking at all the documents and documenting that you have done the work necessary to make the loan. But I would also argue that part of the solution to dealing with these accusations of excessive zeal by investigative agencies is for everyone, including the bank authorities, to not label a banker based on the outcome of a single loan, but instead to look for a pattern across loans. If a banker makes an excessive number of bad loans compared to his cohort, he deserves at the very least to be questioned about what was impelling those loans. But if a banker makes the occasional bad loan in the midst of a large number of good ones, he probably needs to be rewarded rather than questioned. And so looking at the pattern of lending over time, the pattern of performance probably makes more sense. Of course, for this to be useful, one also has to have some changes in the current system where, by emphasizing committees to judge on loans rather than individuals, we tend to obfuscate responsibility. So nobody really can be held responsible for a bad loan, which then takes the investigative agencies down to the people who are closest to the loan rather than the people who may deserve to be taken to task. Now, let me end by talking about some of the responsibilities of the regulator, and I will end with that. Let me talk a little bit about the responsibilities of the regulator and then a little bit about the responsibilities of the government. The regulator is not meant to give the loans. The regulator is not meant to assess the quality of the loans when they're given. The regulator has no ability to do that. Most of my staff have worked their whole lives in the RBI. They've never worked in a bank. So they would not know how to make a good loan. That is not their skill. So trying to say regulators should have stopped the bad loans doesn't understand, somebody saying that doesn't understand regulation. The regulator's job is to identify the loan that has gone bad, identify the people who are masking the loans by making loans just before loan repayments come in. That is the regulator. The regulator's job is to ensure that bad loans are appropriately recognized in a timely way and that appropriate provisions are taken. Now, sometimes regulators get into the mood of the general public and say, well, maybe we should exhibit forbearance. We should not force the bank to declare this a bad loan. I was asked about that on this dais itself. And that's a natural feeling. Sometimes you feel, just give it a little bit of time, it'll come back. The loan will become performing again. Don't declare it NPA now because no bank will lend to it. So forbearance is not a crime. A lot of regulators exhibit it for a little while. The problem is it's a very risky strategy. If the loan comes back, well and good. If the loan doesn't come back, it tends to grow bigger and bigger and badder and worse and worse. So at that point, maybe 3 or 4 years from when you started forbearance, the problem is 5 times the size of the problem when you started forbearance. In hindsight, you should not have exhibited forbearance. But at that time, not only you, but everybody else was saying forbear. So this is important to remember that forbearance is a very risky strategy on the part of the regulator, and we've seen that at least in some cases it simply hasn't worked. The loan hasn't come back, in fact it's gotten worse because banks have overlent. So what we did was we stopped forbearance in 2015 when we knew things weren't going to get better on their own. In fact, they would get worse. And instead, we need to clean up at this point. We have a much bigger problem than we had in 2007, 2008, 2009. But we are very confident that our banks have the capability of cleaning up and have the capital to do it. It will be manageable. It is manageable. And they are, in fact, managing it today. The silver lining in all this is the very numbers I showed you, that credit growth has been slowing for the public sector banks, suggest they're not taking one other route to escape bad debt problems, which used to be the route taken in the past. Let me increase my lending tremendously so that the denominator goes up very fast, right? And the numerator, bad loans, therefore shrinks with respect to the denominator. That is often the worst strategy one can follow, because in expanding your loans very quickly, you make a lot of bad loans that come to roost years down the line. Now, often people say, okay, you can't really do anything about the cleanup, you should do the cleanup, but perhaps you can cut interest rates significantly because that will give the distressed borrower some space to manage, right? Now, one of the problems today, as you know, is that banks aren't passing on these lower interest rates, partly for some of the reasons we've discussed here, because they don't really see the ability to make new loans anyway. But another problem is when you have a very distressed promoter, if in fact the policy rate is cut, banks don't necessarily pass on that lower interest rate to the heavily indebted promoter because they want to suck out every rupee he generates for their repayment. So for the heavily indebted promoters, the idea that cutting interest rates will make credit easier is simply not right. Let me turn finally to what the government should do in this process of cleanup and what it's doing. Clearly, it's speeding up the debt recovery process, it's speeding up the bankruptcy process. Both these will pay high dividends going forward. But it's also taking actions to make sure that this problem doesn't recur by improving the governance of public sector banks through the Indradhanush initiative. Breaking up the post of chairman and managing director adds more governance to the bank. Strengthening the appointment process by bringing in the bank board bureau is also very important. And over time, decentralizing decisions to boards of the banks, staffed by competent professionals, will be very important in improving the governance process. A second aspect of improvement in the banks is to infuse bank capital. And clearly the government has set out some ideas about how much capital it will infuse. Capital infusion into weak banks should ideally accompany an improvement in governance, but given the losses that banks have to absorb, there may be some need to do it even while you're in the process of improving governance. Now, governments are sometimes reluctant to infuse capital into banks because there's all sorts of other competing needs. So long as they're alive and functioning and solvent, why infuse more capital? But I would argue this kind of picture that I showed today, the shrinkage in credit, especially to certain sectors, suggests that capital infusion into the banks can be a very, very high return investment for the government because it will help speed up the process of cleaning up, but also then give the banks some space with the capital that's left to make the loans that are needed to increase the pace of the economy. And finally, I will say that there are some sort of arguments that are put out in both the economic survey earlier this year, but also by some newspapers, that the RBI should capitalize the public sector banks by infusing equity into them. I think this is a non-transparent way of proceeding, which gets the banking regulator once again into owning banks, which is a serious conflict of interest. Our last bank that we owned was State Bank of India. We sold it to the government. Doesn't make sense for us to get back into the business of owning banks. Instead, the way we can best help this process is for us to pay the maximum dividend that we can to the government and just retain enough buffers consistent with good central bank risk management practice. And indeed, this is what we have done. We've increased the dividend we've paid to the government significantly from the past. Over the last 3 years, we've paid over 1.5 lakh crores, and the government should use this or other funds to infuse capital into the bank. Alternatively, there's a less effective form of capital the government can infuse if it is short of cash at some future date, and that is for it to issue the banks government capitalization bonds in exchange for equity. The banks would hold on to these bonds on the balance sheet. The problem is, relative to cash, it would tie up their balance sheets, but it certainly would be capital and can help them lend. So, bottom line, it's been a long talk, I know, but I wanted to make the case that if there's one big agenda item before us today, it is to complete the cleaning up of bank balance sheets and to restart credit growth from the public sector banks. I think if we do that, and the government and the RBI are engaged in helping the public sector banks do it, we know the process working. If we take it to its logical conclusion, the public sector banks will be set to finance the enormous needs of this economy once again in the not too distant future. Let me stop there. Thank you very much.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.